Hello everyone, welcome to another video. If this is your first time here, welcome to the YouTube channel. My name is Rodney. Please make sure to hit the notification bell, subscribe for any time I post a new video. I'm gonna have to speak a little bit loud because of the noise in the background. Okay, I'm near the interstate. I'm currently recording this video in Texas. So today we're gonna talk about exactly when we should expect a market turnaround in the trucking business. When exactly we should expect things to start to get back to normal in the trucking industry. Like I said again, I'm sorry if I been speaking a little bit loud. So just to cover the noise in the background, so I could hear myself talking just a little bit. Sometimes I would be increasing my voice. So yeah, when exactly we should expect that to happen. But first of all, before we even dive into that subject, you have to understand the economy. The most importantly, you have to understand how price and demand works. I'm assuming so. If you're in the trucking business, okay, if you're in the trucking business like me and you, as truck drivers, you probably have an idea on how price and demand works. So I don't have to stay too much into that subject, so I don't have to keep on repeating stuff like that. So the video don't be too long. So let's move on to the next step. Which is the economy, right? How exactly the economy works, especially in this inflationary phase we're in right now with the economy, meaning that inflation is kicking our butt. Okay, this is one of the key indicators that will tell us exactly when will be starting back to normal, meaning that when the trucking industry will get back to making good money again for truck drivers like you and me, owner operator, lease operator, even company drivers, right? So the economy, inflation, right? Inflation was at the 9 level range. It was really high. Based on data and history, inflation was really high. So the Fed, you have to remember that, okay? You have to remember that name. The Fed kept on fighting inflation, and they brought it down to they brought it down to the 3% level range. But at the 3% level range is sticky because they plan was to bring it down to the 2% level, but it's hard to bring it back to the 2% level because for them a stable economy have to, the inflation for the economy to be stable, the inflation has to be at the 2% level. So they're trying to keep on fighting it, to bring it back to the 2% level, which, like I mentioned earlier, it's sticky at the 3% at the 3% level. So right now we have inflation. Inflation means, like, the economy was booming, people had too much access with too much money, and they were ordering stuff like back and forth, left and right. They were ordering stuff online. Truck drivers were making a killing over the world. You know what I'm saying? We were killing it because people had so much cash in hands. You remember, like they gave like stimulus checks. You remember when people had to take PPP loans, all of that. Money was like flowing into the economy almost, like I could say, for free. People had access to cash and they were going crazy. They were buying a lot of like stuff they didn't even need. So truck drivers had a lot of like supplies. Like they had a lot of demand. Like there was a lot of like demand for truck drivers because the businesses needed like to move those supplies. Okay, they needed us as truck drivers. So we were like, this was like a trucking market. This was like a truck driver market. So we had choice. Like if we didn't want to take this load for $3 per mile, $4 per mile, we could get something real quick for $5, $6 per mile 2 years ago, which is different from the scenario we're experiencing right now, right? So when exactly we should expect a stabilized, like money or opportunity for truck drivers. I'm not even talking about, like crazy the way it was like, like 2 3 years ago, but like at least a $3 per mile range, 3.50 $4 per mile range for truck drivers, like owner operator, lease operator, to move freight. A company drivers could make a good income. They could expect to make at least a $2,500 per week and get back to their family safely and stuff like that, so they don't have to drive like crazy in order to make more money. When should we expect that? Well, the thing is, you have to use the key indicators of the economy, which is CPI data. Okay, we're gonna talk about CPI data. The CPI data is a measurement of the economy. It's the measurement of the economy that indicates us exactly, not exactly, like somehow how exactly the economy is growing. So which is like, has to do with inflation, how exactly inflation is moving based on how you see like those data. So those data come out, every month, or should I say like the like for the prior month it comes the next month. I don't know if that makes sense. Like, let's say for example we currently like in September right now, right? We're in September. So August CPI data come in September. September CPI data will come on, October. So this is how CPI data comes out. Hopefully I get that right. So when CPI data comes out, okay, the Fed analyze it, the data, and say like, okay, hey, inflation is not coming down fast enough. We have to go hawkish, which means we have to be really aggressive with interest rate. Okay, you have to understand the Fed has been increased interest rate for the past 12 months. Okay, for 12 months straight, they were increasing interest rate in order to fight inflation, because like I said, the economy was booming, causing like an inflationary phase, like because people had access to too much cash, they were acting crazy. Now everything price is going up, went up like crazy. You could see price of cars, price of houses, price of everything double, triple, because people kept on buying ordering stuff. Because when there's a lot of demand, what happened? When there's a lot of demand for a certain type of supplies, it increases the price. This is how economy works. Okay, the Fed trying to ease that, trying to slow down the economy. In order to do that, he had to keep on raising interest rate, which is what they did for 12 months straight. Now they're in the phase where inflation comes down like from 9% to 3% right now, but they're trying to bring it to 2%. So what they need to do is they need to keep on raising interest rate. This is a problem. Every time there was interest rate, things become more expensive to possess, like food, energy, like phone, I don't know, milk, eggs. I know I said food before, but I'm just throwing examples at you so you could understand better. Those things become more expensive because the Fed plays a big role in the economy. So how it works? The Fed has access to the money printing machine. Literally, there's access to the money printing machine, right? If the other one is a private company, okay, it's not part of the government. The Fed is a private company, okay? The Fed is private. It's not like nothing to do with the government. The government could go to the Fed and borrow money, actually. So let's say, for example, banks. Banks go to the Fed, right? They borrow money to the Fed at a certain percentage rate, right? A certain rate. And they come to you, like people and me and you, they borrow us money back at a higher rate when they get it, like from the price they get from the Fed, because they have to make money from you plus the money they get from the Fed from you as well, in order to like pay back what they owe the Fed. You see how this works? So the bank institutions have to go to the Fed, borrow money, and they distribute it to me and you, and then we have to pay it at a higher interest rate. So the Fed interest rate right now is at 5.5% level range, right? Which is really high. That's why you see like housing, like the housing market is like, it's ridiculously high. Okay, the price of the houses like are so high right now. You cannot even afford a house if you don't have half a mil. If you don't have like 500K, don't even bother to go to the market and try to get a house right now. Okay, this is some other subject. So let's focus on the one we're talking about right now, which is the trucking industry. I'm gonna get back to you guys. I'm gonna come exactly to where I need to be, but we have to understand those phases first in order to know exactly when we should expect a better income in the trucking business, right? Bear with me. So when they raise interest rate like that, money become more expensive to borrow from them. Money become more expensive to borrow from them. So banks are slowing down on going to the Fed because the interest rate is so high. If they borrow money from them too much, they won't be able to make an income out of it, so they could pay up and then pay the employees and stuff like that. So they cannot really go to the Fed as fast as they used to anymore. They have to use like different strategy. Okay, that means like whatever they gave it to you, whatever they gave to you before, they have to increase the interest rate on it too, so they could have enough to pay back the Fed. They could have enough to pay back. That's why you see like those credit cards bills right now. The interest rate, the rates that you have to pay for the interest you have to pay on those credit cards, they becoming higher and higher. $300 you have to pay $30 interest rate monthly. if you own, like, for example, $300, like $400 on a credit card, okay, this is what's happening because of the Fed interest rate. Okay, so money become more expensive to borrow right now, causing a slowdown on demand. Okay, this is where truck drivers suffers the most because if demand slows down, people won't really need truck drivers that much because the way we make money in this industry is if demand keeps on growing or stabilize, but demand is slowing down, so people don't order stuff online the way they used to anymore. Because if they had $100, right, to order 3 items, let's say for example on Amazon, right, they cannot use that the same $100 anymore to order 3 different items anymore. They could only use it to order 1 item. And the thing is, if they use that $100 from their credit card, they will get charged on a higher interest rate. So therefore they don't want to do it. They're slowing down on their spending. That causes truck drivers to suffer. Less freight available on the market, and the thing is, we had so much driver coming in into the trucking industry. So the trucking, the driver range is really saturated. I'm not gonna say oversaturated, but it's really saturated. And we have a lot of drivers sitting on lines waiting for freight, and we have little freight to move. I've discussed this on my previous video, so I don't have to keep on going back and forth on this. So now, what should happen? The Fed needs to bring inflation down to the 2%. Remember, I told you that, guys, that it's at the 2% level. CPI data comes out, monthly, right? I have to increase my voice because so much noise in the background, guys. I'm sorry. They have to keep on raising interest rate until they see the economy is slowing down the way they want it to. To be honest, they don't want to cause it. They don't want to cause the economy going crazy like that. But now they want to bring it down again. So they have the power to do everything. So let's keep on going. So they seeing it going down, but not as fast they wanted to. The Fed used to use CPI data, okay, as a key indicator to see how inflation is behaving. Now they're not focusing on the CPI data anymore. They're using a different type of data, okay, to track down the inflation cause CPI. Core CPI comes out, I think, monthly as well. They use it in order to see how inflation is acting right now. But the problem is CPI data is at 2% level range, but core CPI data is at the 4% level range. Core CPI data is everything that's been going on into the economy, but it's exclude food and energy, because CPI data has food and energy on it. They find it too volatile in order to calculate inflation. So they use core CPI instead because it doesn't include food and energy. So they use it because it's less volatile. CPI is more volatile than core CPI. You understand? So they use core CPI instead now to identify or to calculate the data for inflation and see how it's moving. So core CPI is at the 4%, I think, the 4% level range right now. They need to bring it to the 2% level range. But the problem with core CPI is that it's sticky as well. It's sticky at the 4% level range, and they're doing everything they can on their power to bring it down to the 2%, which means they will have to keep on raising interest rate. But they have a target though. Their target is to raise interest rate to 6%. That was the target. The target was to raise it at between like 5.5% to 6%, but they're already at the 5.5% range. So they could raise it up to 6% if they don't see the economy slow down the way they want it to. If they don't see inflation wage is slowing down, so that's why the Fed kept on raising interest rate monthly or like every other month. Sometimes after they seen the CPI and the core CPI data result, they will act eventually. So every month, CPI data or core CPI data comes out based on what they seen from the indicators. Okay, if they don't like it, they will be going hawkish. They'll be going really, aggressive on raising interest rate. Every time there was interest rate, you will see gas price going up. You will see food price going up at the market. At the grocery store, at the gas station, you will see everything starting to go up again because they kept on raising interest rate. That's why you have to keep eye on those factors in order to analyze, put a good judgment, and see when exactly the economy will start to get back to to normal, and then truck drivers will start getting good money. Okay, when exactly that will happen? This is the thing. When exactly that will, I know this video is long, guys, but it's a lot of information. Like, there's some stuff you cannot really just like cut it, and then just go to the point. You have like to go slowly, and in order for you to to build the understanding of the subject. I hope you guys understand that. And if you find this helpful, please drop a comment, and give me a thumbs up. This is really crucial. This is really good for the YouTube algorithm. So let's keep on going. When should we expect things to start getting better? We have to track down the data, the report data. You have to get involved. You have to know exactly how CPI data and core CPI data comes out this month. Let's say next month. See the difference between the prior month. Okay, you can see how the Fed will react to it. You will know if you see it's going down nicely. You would that this is so loud. If you see it's going down nicely, okay, you would know that the Fed will be acting a little bit dovish. Will be acting, not too aggressive with interest rate. They're probably gonna slow down. So there's something that called Fed pivot. The pivot is when they trying to like reverse interest, because like all these uh rates they put, all those like rates hikes they put in the economy, that eventually if the economy is slowed down and inflation is stabilized, they will have to start removing those, because they cannot keep it based on whatever like the economy rules applies for. So they have to remove it. So there's something that called Fed pivot. The Fed pivot will happen when they see inflation stabilize to the percentage level range they're expecting it to. So meaning, if inflation gets back to the 2% level range, they have to start cutting rate now. They were adding weight, but they have to start cutting weight. But the Fed pivot has three phases on it, three phases, right? The first one is they have to stop putting more rates hike, adding more rates hike. If they stop doing that, they say like they're definitely gonna stop doing that. This is a good sign. They started to pivot. After that, they will have to keep rates hold it. So let's say they get it to the 6%. You remember I told you it's up 5.5%. Let's say they get it to the 6% rates, right? If they stop putting more rates, and then the second thing is they keep it, they hold it like for months, almost a year. I don't know. I don't have a crystal ball. I don't know for how long they will keep it, right? If they hold it like that, the third step will be is removing weights. Once they start removing weights, we're gonna see like price of things starting to go down slowly. So they're not gonna do it like just one time. Everything gets back to normal. They're not gonna do it like that. They're gonna do it slowly. They're probably gonna do it every month, every 2 months. I don't know, but they have to remove weights. Cutting weights now. Cutting weights. Things was price of things we're starting to get back to normal, and people will be feeling a relief, and we'll get back into a normal market or a normal economy. But this will take time. A lot of analysis says they will cut weight in 2023. I don't see that. A lot of people don't see that. I don't see it myself. Personally, I don't see it, because they're still trying to fight inflation to the 2% level. Why would they cut interest and then inflation is not going down the way they want it to? Like last month, okay, I think for the month of August, I don't want to mess that up, but I think for the month of August, inflation showed sign that is going up slightly a little bit. Why would the Fed cut an interest rate, but start raising interest rate while inflation going back up? It doesn't make sense. So as long as inflation is showing signs of going back up or doesn't want to come down, the Fed will keep on raising interest rate. They say clearly at their meetings every time. Keep an eye, at the meetings. Try to understand what they're saying, and you will get a better chance to understand how or when exactly we should expect a market turnaround, especially for the trucking industry, guys. Okay, this video has been so long. I'm sorry I have to give you guys the whole juice of understanding things exactly the way they should be, in order for you to know when we should expect a market, turnaround in the trucking business. So we could start earning money again, so we don't have to, do too much. We should start, how should I say, like, we should start, getting paid, rightly, because right now we're not getting paid rightly. We're getting paid, like, based on those every crazy things that going on in the economy. And if you're looking at the risk ratio plus the reward ratio, which is what we're doing over the road driving, stay away from our family, our friends, our loved ones, and stuff like that. The rewards we're getting, like, right now for those sacrifices, it's not worth it. It's not worth it at all. It's because of everything that's going on in the economy. I know I haven't covered, everything from this video. This video is already too long. It's already like 20 minutes already. So I will be covering, like, the other stuff on the next video. Recession. How exactly the trucking industry will be in a recession. This is another subject to talk about, in the next video. I know I haven't covered everything yet. I'll try my best to stay, like, on track. But whatever, like, you see that I haven't mentioned in the video, leave it in the comment section below. Okay, let me know. Share with the family, because I have a lot of stuff I haven't mentioned in the video that I forgot to mention, and blah blah blah. So leave it in the comment section below. Don't forget to give the video a thumbs up, man. Come on now. I've seen you guys subscribe to the YouTube channel, and I appreciate that. Okay, but you have to also give the video a thumbs up. Okay, my videos have over 1,000 views, and I have like 100 likes. Come on, guys, give me a thumbs up, for the YouTube algorithm, and I'll see you guys in the next one. You guys stay safe, all right?